Gentlemen, Wall Street hit a new high, 40,000 last week. And last night, Nasdaq inched towards a new high again. Well, what does basically new highs in the US markets actually mean for real estate investment trusts in this part of the world? And what does it mean for Singapore stocks in this part of the world? Let me delve into in deep detail, in this week's video. So as usual, do like our videos, tell your friends about it as we give you the latest updates on investments, investment related, and how to multiply your wealth, which is the key thing in growing your wealth. Sentiment, from the red dot, or rather the red line given there, when Wall Street was like 10, or the Dow was actually like 10,000 way back in 1997. And I can vividly remember it's because that was when I first started working in Wall Street. Yes, I was actually based in New York for 3 years, servicing the hedge funds and the index fund managers, living out of Greenwich, Connecticut. And Merrill Lynch and the likes of State Street Global were some of my better clients. And you can see in the last 27 years, then Wall Street have actually climbed 4 times. Yes, ladies and gentlemen, the Dow Jones have climbed 10,000 in 27 years ago, now to 40,000. So if you caught it right, investing in the Dow stocks, you would have actually seen the value of your stocks quadruple. In fact, if you look at this particular chart, in reality, the Dow has actually gained 423%. At that time I was in my early 20s. If I have actually put all my money in there, I would have actually quadrupled. Well, unfortunately, that didn't happen, but I did actually gain and ride some of it. Now, contrast this, ladies and gentlemen, with the woeful and terrible performance of the STI. Now, this, ladies and gentlemen, is the chart of the Singapore STI index, which we have told you to avoid, for the longest period of time. As you are aware, essentially, even the authorities and MAS in Singapore has actually been actively engaged to how to actually make Singapore stock market a better stock market. Well, look no further, because if you look and just draw a line through at 3003, in the last 10 years, the market has not gone anywhere. And unless and until someone tells us and take severe remedial actions to actually coax the index out of this doldrums, the Singapore market is not going to go anywhere. Well, not even in the next foreseeable future, as what they have done in the last 10 years. Now, this was also my prognosis, and to this extent, I've already foreseen that, and that's why I quit the stockbroking industry and investment market 10 years. Well, it's been 16 years since I retired, way back in 2009. Yes, ladies and gentlemen, this was actually a Straits Times or Sunday Times interview way back in December 2009, where they captioned me as the millionaire with a heart of gold. That's Mr. Gabriel Yap in his early 40s, senior dealing director turned philanthropist. Well, you can read the article. Well, it's been a fantastic 16 years since I quit and then joined, but in the process, one of the endeavors that I did was actually to ham Reader's Digest, the finance section. And you do read my Money Savvy column, which I actually wrote a couple of years back. One of the key things I've said is that the right asset allocation is key in multiplying your wealth. So, ladies and gentlemen, if you had been following us very closely, reading on my articles in Reader's Digest and my interviews in Business Times, Lian Zaobao, and the various foreign media, and following us on YouTube and CNBC, Bloomberg, you notice that essentially we have always told you that the right timing in positioning your assets is key in growing your wealth. So 16 years ago, I was lucky enough to be able to gravitate practically all my assets out of Singapore equities and going into and gravitating towards US equities as well as European equities. In fact, in many of GCP global investment classes, we touch on technology, which touch on artificial intelligence, we touch on data centers, and we talk about the growth of digitalization. So if you've been following and investing in our classes, you notice that essentially some of the key things that we've been saying all this while is to have the right asset allocation into key sectors in the US, including technology, information technology, information communications, cybersecurity, pharmaceutical, and within Europe itself, we look at the key luxury stocks like Hermes, LVMH, L'Oreal. We look at key pharmaceutical stocks as well as some of the um, financial institutions. So essentially, if you look no further, ladies and gentlemen, if you think that the Dow Jones 4x is already very good, look no further. In fact, S&P has actually 6x instead. Yes, risen 600%. And of course, as you are aware, the S&P index is a market-weighted index, so the likes of your big sevens or magnificent seven like your Google, Amazon, Apple, these are the ones that drive the valuations. But nonetheless, some of the second tier companies, like for example, American Express, Visa, MasterCard, and essentially the likes of Broadcom also have done pretty well. Those are actually some of the key names that we actually talk about in our investment classes previously. And as you can see, they have 6x in line with the S&P. So you really want to grow your wealth, then you should be attending our classes and join us for some of YouTube video. And look no further, ladies and gentlemen, the star of the creme de la creme is the Nasdaq. The Nasdaq index, which comprises the key technology stocks, have actually gone up 10 times. Yes, ladies and gentlemen, imagine you put in $1 million, that $1 million has grown to $10 million within the span of how long? 27 years. And essentially, that's the whole idea about picking the right stocks. So you notice that essentially a lot of us, a lot of people, a lot of YouTube comments basically have uh, took us by surprise, or when we actually say that when interest rates started to increase for real estate investment trusts, you should not be looking at real estate investment trusts as investable assets. We told you to actually shift out of real estate investment trusts, but real estate investment trusts, because of the uh, certainty of the dividend payout on a quarterly or half quarterly basis, will actually represent a very good trading stock. And in our last video, which I presented my personal trades, trading Capital Land Integrated Commercial, one of the better REITs to worth trading on almost on a daily basis, I would say, which I present to my GCP global investors, which included high net worth individuals, family offices, and index fund managers in my last class in March. You notice that I've showed in February, over a period of just 3 weeks, I made 4,111 on Capital Land Integrated Commercial, trading basically just 76 lots, as you can see from the track record that's given. And then again, towards March itself, I've actually done another trade, making $2,694 over a 1 week period. Of course, in our next coming class on the 29th of June, I'll show you more trades basically of how I actually traded and made money on Singapore REITs. So while I did say in my video that why REITs are bad and will continue to be bad, but in terms of essentially trading ability, what are some of the key traits that you should be looking for? After all, the whole macro picture was shaped by my Business Times interview on Monday of 15th April, where I say that REITs results are like a bicycle. They are weighed down by interest costs and higher gearing ratio. But is that about to change? Well, find out more when we hold our next class, REITs class on 29th of June. So do sign up, quickly and join us to know basically how to multiply your wealth through technology or REITs or some other instruments. So till then, next week, have a good week ahead and enjoy the new highs as what we have been doing and enjoying in the last 17 years.